Hello everyone, welcome to EduTap and welcome to today's Finance 360-degree session. In today's session, we are going to discuss a very important RBI notification. Okay, so the RBI notification is regarding the credit facilities, and you have to understand that what are the limits that the RBI has notified, what are the different criteria that the RBI has notified. Okay, so all of this we are going to discuss in today's session, and this is going to be a very important session for all of you because today you will get to know that how you can take loans against the shares. Is it allowed? Like how much is the loan to value ratio against the loan that you are taking against the shares or your mutual funds and such. So we will start with the session, and today's session is going to be important, okay, from your common understanding as well as from the examination point of view. So RBI has released the notifications for the commercial banks and for the small finance banks regarding the credit facilities, okay, that will be provided against the eligible securities. Now, what are the eligible securities? What are the securities that are not eligible? So criteria have been provided that we will discuss, and the limits have been decided that we will discuss, okay. So let's get started without any delay. Give me a thumbs up if I'm clearly audible and visible and everything is fine. So give me a thumbs up and let's get started with the session. But before that, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below, okay. So we are going to start with the Credit Facilities Amendment Directions 2026. I hope I'm clearly audible. Okay. So we are going to start with the Credit Facilities Amendment Directions 2026. Now the directions are a little lengthy, so we are going to go a little faster, okay? And remember that the limits, the criterias, they are going to be important from the examination point of view. So the RBI has released the Credit Facilities Amendment Directions 2026 for the small finance banks and for the commercial banks to introduce a new framework for loan against eligible securities and lending to capital market intermediaries. So basically try to understand that let's say you have invested your 1 crore rupees in the shares and mutual funds. Okay, now you do not want to liquidate it, you do not want to sell the shares, you do not want to sell the mutual funds, but you require immediately you require the 25 lakh rupees. So what you can do is you can take the loan against the shares, against the mutual funds that you have, okay. So this is the idea that the RBI has informed, and the RBI has provided this amendment informing clearly that individuals, they can, the people like you and me, we can take the loans against our shares, against our mutual funds, and the guidelines have been provided to the banks, okay. The amended guidelines have been provided to the banks that till what limit we can take the loans from the banks against such kind of securities, as well as what are the different criteria. So this is the basic idea. So basically Credit Facilities Amendment Direction talks about two things. First is the loan against eligible securities. So individuals like you and me, we can take loan against the eligible securities, as well as non-individual person that are not the financial institutions, they are not the financial entities, excluding the CMIs, the capital market intermediaries. So excluding the capital market intermediaries, the other non-individual persons, they can also take loan against the eligible securities. Now what are the capital market intermediaries? The capital market intermediaries are like the brokers, the clearing members, that we will discuss more in the coming slides, okay. Now again, in this amended directions, there is also the discussion that has happened regarding the lending to capital market intermediaries, lending by the banks to the brokers, the lending to the clearing members and such. So this is the brief idea that what we are going to discuss in this session, in this particular amendment direction, that we are going to discuss about the loans against the eligible securities and the lending to the capital market intermediaries. So let's get started. Till now, any confusion, anyone? Okay. So starting with the first part, that is loan against eligible securities. Now the amendments that shall come into force from 1st April 2026. So all the amendments that we are going to discuss, they are going to come into force from 1st April 2026 or an earlier date when adopted by the bank. So this is the last date, that from this date the amendment will come into force from the side of the RBI, but the bank can adopt the amended directions on the prior basis also. This is the last date, you can understand, for adopting the amendments. Now loans against eligible securities. So the individuals, we can take the loans against the eligible securities. What are these eligible securities? So let's start the discussion about the eligible securities. So listed group 1 equity shares and preference shares. They are the eligible securities against which we can take the loans, So group 1 shares means they are the shares that are traded a lot in the market. They are liquid shares, okay? That means they are the shares of the big corporates and such. So the listed group 1 equity shares, the normal shares as well as the preference shares, in which you get the preference in the returns, in the dividend. Okay, preference shares are the shares in which the shareholders, they get the preference, they get the priority in providing the dividend, as well as they do not have the voting right, because they are getting the priority in getting the dividend, they are getting the preference in getting the dividend, the part of the profit. So they do not get any voting rights, they do not get the voting share. That is the idea. So listed group 1, that means highly liquid, highly traded equity shares and preference shares. They are the eligible securities against which the bank can provide the loan. So if you have the equity share, if you have the preference shares of the group 1 in listed entities, so this is the idea. Now government securities, you can take the loans against the government securities. So if you have the government securities, including the treasury bills, sovereign gold bonds, or other dated government security, so these are also the eligible securities against which the bank can provide the loans. Okay, now listed debt securities, including, so listed debt securities, the debt securities, that is the securities in the financial market through which you can take the debt, the corporates can take the debt. So basically debt instruments, the listed debt instruments of the corporates, of the companies, including the convertible debt securities. These convertible debt securities, they can be converted into equity shares, they can be converted into shares. So that's why they are convertible debt securities that can be converted into the shares. Okay, so listed debt securities, including convertible debt securities that is rated BBB or higher, these are also eligible securities. Units of mutual fund schemes, so if you have the mutual fund, okay, so you have the units in the mutual fund. So units of mutual fund schemes which are listed or where the repurchase or redemption facility is provided by the asset management company. So basically if you have the units of mutual fund scheme, so these are the eligible securities. Units of exchange traded funds. Exchange traded funds, basically like the mutual funds, they pool in the money, they collect the money, they pool in the money from the investors, and this money is invested in the shares, or this money is invested in the different kind of instruments, in different kind of securities. Okay, similarly exchange traded funds, they also collect the money, from the investors, and this money is invested in, let's say, some Sensex index. This money is invested in the securities or in the shares as per the index. So the ETF, that is the exchange traded funds, they follow or they track certain indexes. They can track the, like there are Bank Nifty ETF, or there are Sensex ETF, or there is Nifty 50 ETF and such. So these ETFs are basically tracking the index. They are basically tracking some Sensex index, or they are tracking the Nifty 50 index, or they are tracking the Bank Nifty index. So whatever are the shares, or whatever are the companies in the same proportion, that is in the index, that same shares in the same proportion is kept in the ETF, is being bought by the ETF. Okay, so ETFs, that is the exchange traded funds, they are the exchange traded funds, they are like the mutual funds that are collecting they are pooling in the money, they are collecting the money from the investors, and they invest this money, they invest in this money in certain index. That means ETFs, they track the index, and they are investing the money in the same proportion, in the same shares as notified by the index, by let's say Bank Nifty index or such. So that is the idea. You cannot directly invest in the index, the investors, they cannot directly invest in the index. So we invest in the ETFs, like if you want to invest in the Bank Nifty, so you, rather than directly investing in the Bank Nifty, you invest in the Bank Nifty ETF. Okay, because the ETF is tracking the same shares, is tracking the same companies in the same proportion as notified by the index. Okay, so you invest in the stock exchanges, you invest in the ETFs, and that's why they are called exchange traded funds, because these funds that are collecting in the money from the investors and investing this money in certain like shares in the same proportion as the index, so they are exchange traded, they are traded on the exchanges. NSE, BSE and such. Okay, so basically this is the idea. So units of exchange traded funds excluding the commodity ETFs, excluding the commodity ETFs. So ETFs that are tracking some commodities, so they are excluded. Other ETFs, other exchange traded funds, basically they are tracking some index, Sensex, or let's say the Nifty 50 or Bank Nifty and such. Okay, so ETFs that are tracking some index, they are investing in the shares in the same proportion as this, as per the index. Okay, so such kind of ETFs, if you have the units of the ETFs other than the commodity ETFs, so they are the eligible securities. Units of real estate investment trust, these are the trust that invest in the real estate by collecting the money from the investors. Infrastructure investment trust, they collect the money from the investors and they invest in the infrastructure units. Okay, so this is the idea. So you have the units of the REITs or InvITs, so then also these are eligible securities against which you can take the loans. And I hope this is clear. Okay, so loan against eligible securities. Eligible securities are the listed group 1 shares, government securities including the treasury bills and the sovereign gold bonds, and the listed debt securities that is rated BBB or above, and the mutual funds, exchange traded funds excluding the commodity exchange traded funds. So exchange traded funds, they are traded on exchanges, they are traded on exchanges, and they usually track some index and they invest these exchange traded funds, getting the money from the investors, pulling in the money from the investors. They trade in the shares or they invest in the shares in the same proportion as the index. Okay, so they track some index, they track either the Bank Nifty index or they are tracking the Nifty 50 index or such, and they are traded on the exchanges. REITs and invest, the REITs are the eligible securities against which you can take the loan, against which you can take the loan. Now the scope, lending to individuals. So loans to individuals including Hindu undivided families which are not commercial entities shall be covered under this section. Okay, banks may lend to individuals against the eligible securities that we have discussed just now, subject to the loan to value ratio. Loan to value ratio, let's say you have the shares and the market value, the current market value of the share is 1 crore. Okay, so you have certain units of shares, let's say you have 1000 units of shares, you have 1000 shares and the current market value of these shares is 1 crore rupees. So should you get the loan worth 1 crore rupees only? No, there is the LTV, that is loan to value ratio. So against the collateral value, against the collateral value of the shares that you are providing, how much loan should you get? How much loan should you get? That is decided by the loan to value ratio. Okay, so this is the idea that we have discussed about the eligible securities, but what is the loan to value ratio? If you are providing your shares, if you are providing your group 1 shares, or if you are providing your government securities, if you are providing your mutual funds units as collateral, so how much loan should you get against those collateral value? Okay, prudential ceilings also we will discuss. So now banks shall lay down the loan to value ratio for loans against the eligible securities again according to their own policies, but this is the loan to value ceiling. This is the maximum loan to value that can be provided against a particular eligible security, against a particular collateral value. Okay, so banks, they can decide their own LTV, but their own LTV, their own loan to value ratio should be lower than these. That is the idea. Okay, so this is the maximum that the RBI has notified, that maximum this can be the loan to value ratio. So loan to value ratio is nothing else, it is the loan divided by the collateral value. Okay, so it is the loan divided by the collateral value. If we want to see it in the percentage form, multiplied by 100. Let's say the collateral value, you are giving your home as collateral and your house value is, collateral value is 50 lakh rupees, or let's say 1 crore rupees. Okay, now you are getting the loan worth 85 lakh rupees. So what is the loan to value ratio here? You are against your collateral value, against the house value, you are getting the loan of 85 lakhs. So the loan to value ratio in percentage form is 85% here, 85%, right? So this is loan to value ratio, that is against your collateral value, how much loan you are getting, or what is the outstanding loan, what is the outstanding loan. So that is the idea. Now eligible securities and the LTV ceiling, that is the maximum LTV that is possible. So government securities and including the treasury bills. So as per bank's policy, bank can decide that what can be the LTV ratio. That means it can be 85%, it can be 90%, it can be 70%, it can be 75% or so. So bank can decide as per their own policy. Okay, there is no maximum ceiling that has been determined by the RBI. So bank can decide on their own basis. Sovereign gold bonds as applicable in case of loans against the gold and silver collateral. So when you are giving your collateral, your gold jewelry as collateral, or the gold coins if you are giving as collateral, or silver coins if you are giving as collateral, so the same loan to value ratio that is against the collateral value of gold and silver, that same loan to value ratio maximum ceiling will be applied. Now listed shares and listed convertible debt securities, they can be converted into shares. So if you have the shares and you are providing your shares as the collateral, or let's say you have the convertible debt securities and you are providing your convertible debt securities as collateral. So in this case, your collateral is your shares or convertible debt securities. Okay, so collateral value is, let's say, 1 crore. The loan to value ratio that can be maximum is, the maximum loan to value ratio can be 60%. That means against the collateral value of 1 crore, you can get maximum 60 lakhs. Okay. So this is the idea. The loan to value ratio ceiling is 60% for the listed shares and listed convertible debt securities that can be converted into shares. Mutual funds, excluding the debt mutual funds, units of ETF, the units of exchange traded fund, and units of REITs and InvITs, they have the loan to value ratio ceiling of 75%. Okay. Now the debt mutual funds that have the loan to value ratio ceiling of 85%, and listed debt securities with rating of AA have the loan to value ratio of 85%. AA to BBB, they have the loan to value ratio ceiling of 75%. Okay, and remember that only like the debt securities, the listed debt securities that have the rating of BBB or higher, only those listed debt securities are the eligible security for the loan. Okay, so if a debt security has a lower rating, then the loan cannot be provided. So that's why there is no LTV ceiling. So these are the LTV ceilings that you have to keep in mind, because these are important. Directly it is related to the banks, directly it is related to the individuals and the people, so it is affecting us. Okay, so these are the limits. The maximum ceiling that has been decided by the RBI. The bank, according to its own policy, can decide lower LTVs, lower loan to value ratio. Okay, but this is the highest that the bank can go. So debt mutual funds, why for the mutual funds that are excluding debt mutual funds? So basically the share based or equity mutual funds, they have a lower loan to value ratio in comparison to debt mutual funds, because the debt mutual funds are less volatile in comparison to the shares. The debt is less volatile as per the market condition in comparison to the shares. Shares are more volatile. They can lose their value very fast, right? So that's why the LTV is lower. The LTV ceiling is lower for the mutual funds excluding the debt mutual funds. That is the idea. So LTV shall be monitored on an ongoing basis, that the bank is maintaining this loan to value ratio and the collateral is sufficient against the loan. Okay, collateral is sufficient against the loan. So banks should take the necessary steps to rectify the breaches immediately if there are any breaches that is happening, if the bank has provided the loan that is higher than the share value and such. So that is the idea, but in no case later than 7 working days. So if there is any breach that is happening to these maximum limits, so within 7 days the rectification measures has to be taken. The measures has to be taken by the bank. Okay, so this is the idea. Now, lending to individuals, see whatever are the eligible securities, they have been mentioned here. So if there is something that is not mentioned, that means they are not included. Okay, chalo. Lending to individuals, prudential ceilings. So banks may fix their own prudential limits in terms of their approved policy for loans to individuals. Okay, so prudential ceilings are the prudent ceilings on the loans that the banks have against the collateral of government securities, listed debt securities, unit of debt mutual schemes. So basically it has been said that the banks can decide their own limits, that against the government securities, what is the limit of the loans that the banks are going to provide. Let's say the banks have decided that the total limit of the loans that they are going to provide against the collateral value of government securities is 100 crores. So let's say there are 50 borrowers that are coming. Okay, or there are 5,000 borrowers that are coming that are providing the government securities as collateral value. So the bank has decided its own prudential limit, that till this limit is achieved, only that much will be provided as loan. Okay, so this is the idea. The banks may fix their own prudential limit, the maximum that the bank can provide against a particular collateral security. Okay, in terms of their own approved policy for loans to individuals against the collateral of government securities, including tables, listed debt securities, and unit of debt mutual fund schemes. Now here remember that if the credit rating of the debt security falls below BBB minus during the loan period within 30 working days, new eligible security has to be provided. So basically loan can be provided against the debt securities. Loan can be provided against the listed debt security, and during the time of providing the collateral value, during the time of providing the collateral, let's say there is a individual Kavya. Okay, and there is the bank XYZ. So Kavya has provided the listed debt security that had the rating of BBB minus, or that had the rating of AA. Now the bank had provided Kavya the loan of, let's say, 10 lakh rupees or 20 lakh rupees. Now, the same listed debt security, its rating has decreased because of the decisions that the company has taken for which this debt security is. So, let's say the rating of this debt security is decreasing. Now, the rating is BB minus, or the rating is, let's say, C minus. So the rating of the debt security has reduced. So it is said that if the credit rating of a debt security falls below the BBB minus during the loan period, so the borrower must replace the security with the eligible security. So a new security has to be provided by the Kavya. It can be the group 1 shares, it can be another listed debt security that has the rating of BBB or minus or above and such. So within 30 working days, new eligible security has to be provided. Okay, so that is the idea. Now the amount of loan that can be granted to individuals against eligible securities. So here we have discussed that the bank can decide its own prudential limit, the total limit, as well as the individual limit, that for an individual person, how much loan can be provided against the government securities, against the listed debt security, against the unit of debt mutual fund. So the bank can provide, let's say, 2 crore. This is the limit that the bank has decided, or 5 crore is the limit that the bank has decided on the individual basis and such. So the bank can decide its own prudential limits on the individual basis, okay, for these different kind of securities. But for the other securities like the shares, like the REITs, InvITs, okay, for the other securities, for the other eligible securities, the RBI has provided the ceiling. The RBI has provided the ceiling. So amount of loan that can be granted to individuals against eligible securities other than those mentioned above shall be capped at 1 crore per individual. Okay, so this is the idea that for these securities, the total limit as well as the individual limits can be decided by the bank themselves. But in the case of the other eligible securities, the RBI has decided the limit on the individual basis, that is 1 crore per individual, 1 crore per individual. Okay, within the above limits, that the bank has decided or that the RBI has decided, loan up to 25 lakh per individual can be granted for the purpose of acquisition of securities in secondary markets. That means if you want to purchase the shares or you want to purchase the debt security in the secondary market, where the shares are traded between the investors or the debt securities are being traded amongst the investors. So in the secondary market, if you want to purchase the shares, if you want to purchase the debt securities, in this case, you can get 25 lakh. This is the loan, like up to 25 lakhs you can get from the bank to invest your money, to invest this money in the shares and debt securities and the other securities. Okay, so within the above limits of the 1 crore and the limit decided by the bank, 25 lakh, up to 25 lakh per individual, this is the loan that is granted for the purpose of acquisition of securities in the secondary market. Okay, so you can take the loan from the bank to purchase the securities in the secondary market. Now coming to the next part, that is, banks may grant loans to individuals after ensuring due diligence for subscribing. If you want to purchase the initial, like let's say XYZ company is releasing its initial public offering for the first time, the company is releasing its shares to the public. Okay, so if you want to buy the shares through the IPO, or if you want to buy the shares in the follow-on public offer or under employee stock option plan, so up to 25 lakh per individual loan can be taken from the bank. Okay, but let's say subscription value is 10 lakhs. Subscription value is 10 lakh. Okay, so if the subscription value, that means this much you are investing in a IPO. This is the subscription value, this much you are investing in the IPO. So 75% of the loan can be provided by the bank. 25% should be your own cash. Okay, so 75% means 7.5 lakhs can be provided by the bank as a loan to you. 25%, that is 2.5 lakhs, should be your own money. So basically, if you want to purchase the IPO, if you want to purchase the shares under IPO or follow on public offer or under employee stock option plan, you can purchase the shares by taking the loan from the bank up to the limit of 25 lakh per individual, provided that the loan amount shall not exceed 75% of the subscription value. So if you are investing 10 lakh rupees, 75% of the loan can be provided by the bank. 25% should be your own cash, so that you have your own risk also. It shall be ensured that such shares that you are purchasing in the IPO, that you are purchasing under the follow-on public offer, or you are purchasing under the ESOP and such shares that you are purchasing by taking a part of the loan, these shares will be pledged to the lender upon allotment. That means these shares are the collateral against which you are taking the loan. That is the idea. Okay, now coming to the next part, that is the following loans by a bank shall not be permitted. That means these are the securities that are not allowed, against which loans cannot be given, by the bank. Okay, so these are going to be the securities against which the banks cannot provide the loan. So loan against its own securities. So let's say the bank, it can provide the loan. Okay, now the bank can provide the loan against the eligible securities. The bank, it cannot provide loan against its own securities. Let's say State Bank of India, it cannot provide the loan against the shares of its own bank. Let's say Kavya has the shares of the State Bank of India. So the State Bank of India cannot provide loan against its own security. That is the basic idea. So loans cannot be provided by the banks, by the small finance bank, by the commercial banks against their own securities. A bank can extend loans to individuals against the long-term bonds issued by it for infrastructure financing. Because here infrastructure loans are involved, here the infrastructure is involved, and infrastructure is important for the country. That's why there are some exceptions that are provided for the infrastructure financing and for the infrastructure loans. Okay, so bank may extend loan, bank can provide loan to such individuals, to such investors that have invested in the infrastructure financing. Okay, in the long, basically the bank can give the loans to individuals or investors that have invested in the infrastructure long-term bond. So against this infrastructure long-term bond of the State Bank of India, let's say, or XYZ bank, and the loan is taken from the same bank, in this case the loan can be provided for against its own security. The loan can be provided by the bank against its own security, but this is just an exception, remember this. So bank should not provide loan against its own securities, provided that the bank can extend loan, the bank can provide loan to individuals that have invested in the long-term infrastructure financing bond. Okay, subject to ceiling. Now here the loan can be provided only 10 lakh per borrower. Okay, it is clarified that a bank shall not extend loans against such bonds issued by other banks. So there is also the some criteria that is notified. As well as it is also notified that the bank can lend against the certificate of deposits released by the bank, because the individual has deposited its money in the bank. So against the certificate of deposit, the individual has deposited the money in XYZ bank, and the same bank can provide the loan against the certificate of deposit. Okay, so loans, a bank cannot provide loan against its own securities, but the exceptions are the long-term bonds, the long-term infrastructure bonds, okay, that is released by the bank, and the loan can be provided against the bond by the same bank. Certificate of deposits released by the bank, and the loan can be provided by the same bank. Okay, now loans against partly paid shares. Partly paid shares are the shares that are paid in portion, That means the investor has only paid a portion of the total value of the share. The share, let's say you are buying 100 shares. Now these are worth 10 lakh rupees. You have given only 5 lakh rupees. Okay. So here, these are the partly paid shares. The companies, sometimes they allow the partly paid shares. The companies, they are releasing their shares and they allow the part payment because the company is raising the funds in different tranches, in different levels. Okay, so that's why there are certain partly paid shares where you have bought 100 shares worth 10 lakh rupees, but you have only paid 5 lakh rupees. The other 5 lakh rupees you are going to pay on a later on date. So loans against such kind of shares cannot be provided because here the total shares are not paid for. Okay. Next is loans against securities that are under lock-in requirement. So let's say you have used your shares as a margin requirement to purchase some debt security, to purchase some other securities in the financial market under the stock exchange. Now the same shares cannot be provided as collateral because you have already put your shares as the margin requirement. You have already put your shares as the margin requirement. You have said that after 2 days I will provide the cash and then I will take back the shares and I will take the debt security. So if your shares, if your instruments, if your securities are provided, they are locked in for any kind of margin requirement or security deposit and such, you cannot use those same securities for collateral. Okay. Loans against collateral of IDRs. So basically, let's say a foreign company. Now what is this IDR? Indian Depository Receipt. So foreign company, it wants to raise capital through the Indian stock exchange. So if the foreign company wants to raise capital through the Indian stock exchange by issuing its shares, it cannot directly issue its shares in the Indian stock exchange because this is a foreign company. So what the foreign company can do, that foreign company through the custodian, through the Indian custodian. So this foreign company wants to raise capital directly through the Indian investors through the Indian stock exchange. Okay, so this foreign company wants to raise the funds from the Indian stock exchange, from NSE, BSE and such. Okay, by selling its shares, by selling its equity shares. Okay, now the foreign company, it can connect through the Indian custodian, through a Indian custodian. So foreign companies issuing the shares basically to this Indian custodian, that is the Indian custodian, it is releasing the IDRs, that is the Indian Depository Receipts that are released in rupees. So if the investors, they invest in this Indian Depository Receipts in rupees, they are denominated, first of all, that's why they are known as Indian Depository Receipts, because they are denominated in rupees. So if an investor is investing in this Indian Depository Receipt, that means they are indirectly investing in the shares of the foreign company through the Indian stock exchange. This is the idea. Okay, so if the foreign company wants to raise direct money from the Indian stock exchange, they can issue the shares to the Indian custodian that can release the Indian Depository Receipts in the rupees, in the INR, and investors can invest in this Indian Depository Receipt to invest in the shares of the foreign company. Okay, so they are denominated. The dividend will be denominated in rupees, the shares will be denominated in rupees. That is the idea. So loans against such kind of collateral is also not allowed. So loans against collateral of Indian Depository Receipts is also not allowed. Next is loans against securities of such entities to which banks are not allowed to grant loans and advances. Let's say against Vijay Mallya, the banks are not allowed to release any loans or advances. Against XYZ entity that has done any fraud, against ABC entity that has done any fraud, or they have declared bankruptcy, they are not returning their previous loans, banks are not allowed to provide any loans, further loans and advances to such entities. So loans against securities of these entities can also not be provided. Okay, so banks can also not provide loans or advances to the individuals against the securities of such entities. That is the idea. Now loans to companies for buyback of shares or securities. Let's say a company 123 released its shares, sold its shares to the public. Now the company wants to buy back the shares. So basically, the banks cannot provide the loan to the companies if they want to buy back their shares or securities. That is also not allowed. Okay, so banks, they cannot provide loans to companies for buyback of shares or securities. Loans against commercial papers. Commercial papers are unsecured short-term debt instrument. So loans against the commercial papers and the non-convertible debentures of original or initial maturity up to 1 year. So if the commercial papers or non-convertible debentures, they have the original or initial maturity up to 1 year, so loans against such kind of instruments can also not be provided. So following loans by a bank shall not be permitted if the loans are against their own securities. These are the exceptions. Loans against partly paid shares, loans against securities which are under the lock-in period or lock-in requirement, loans against ideas, loan against securities of such entities to which banks are not allowed to grant loans in advance, loans to companies for buyback of shares or securities, loans against commercial papers and non-convertible debentures of original or initial maturity up to 1 year. So these kind of loans cannot be provided by the bank. Remember these criteria is very, very important. In lending to non-individuals. Now coming to the non-individuals other than capital market intermediaries. So we had discussed about the lending to the individuals. Now we will discuss the lending to the non-individuals. Okay, non-individuals, they can be entities, non-financial entities basically, that are not the capital market intermediaries. So a bank may provide finance, a bank can provide the loans as per its approved policy to non-financial entities against eligible securities that we have already discussed. Those are the eligible securities, those are the non-eligible securities. So these are not the eligible securities. So bank can provide finance, the bank can provide loan as per its approved policy to non-financial entities against eligible securities in addition to other collateral like your asset, your house, your gold, silver can be collateral. Other than that, your group 1 equity shares, preference shares, government securities can also be the collateral. Okay. Now the bank can provide loans to the non-financial entities for financing their own working capital for other productive purposes, that is for the general business purposes. The loans can be provided to the non-financial entities against the eligible securities. LTV ratio will remain the same like for the individuals. We have discussed the LTV ratio, that is the same ratio for the non-individuals also, like the shares, they had the LTV ceiling of 60% and such, so that LTV ratios will remain the same. Bank shall ensure that the end use is the productive purposes, the financing their working capital, the end use is not speculative purposes. Okay, that means the loan is not being used for the speculative purposes. A custodian bank may issue irrevocable payment commitment. What is this irrevocable payment commitment? So first of all, what is a custodian bank? See, a custodian bank is a bank that manages and holds the securities. Let's say a company, a non-financial entity XYZ, it is investing in different securities. It is investing in mutual funds, ETFs, debt securities, shares, and different securities, okay, debentures and such. So if this entity is investing in different securities, so to manage the securities, to hold the securities, as well as to provide functionality to the company, so that the company do not have to worry about its securities, that where the securities will be kept, like in the manner that the management is proper or not, when the securities have to be sold, when the securities have to be bought. So basically the XYZ entity has hired a custodian bank that is responsible for settling the trades on behalf of the client, that is responsible for managing and holding the securities on behalf of the client. So this is the custodian bank, that is the custodian that keeps in its custody the securities and manages and holds the securities for the company, as well as it like for its clients, it's also function as settling the trade. So custodian bank may issue irrevocable payment commitment. Let's say this XYZ entity wants to buy the shares of Reliance Industry, 1000 shares of Reliance Industry. Okay, so XYZ company or XYZ is the client that has informed this to the custodian bank that okay, we want to buy the 1000 shares of Reliance Industry. Now the custodian bank will connect with the clearing corporation, or so the clearing corporation, that okay, the 1000 shares has to be bought by the XYZ. Now the margin has to be provided. provided. For 1000 shares, let's say the 1000 shares are worth 1 crore rupees. So margin of 10%, that is 10 lakh rupees, has to be provided as margin. 10 lakh rupees has to be provided as margin. That has been provided. Now, the custodian bank is providing irrevocable payment commitment. That means the custodian bank is making sure that the client gets its shares, and the custodian bank is providing the irrevocable payment commitment to the clearing corporation that if the client's defaults, that means if the client is not able to pay the rest of the money to get the shares, then the clearing corporation do not have to worry, because the custodian bank will be responsible to pay. So this is the irrevocable payment commitment, where the custodian bank is providing the irrevocable commitment that in case the client is not able to pay, in case the client defaults, then the bank will pay. So irrevocable payment commitment means the bank must pay the clearing corporation of the exchange without any condition if settlement obligation arise. So XYZ client is the client of the custodian bank, which has been the client for previous 6-7 years, and so the custodian bank is holding and managing all of its securities and such. Now the XYZ wants to buy the shares of the Reliance Industry, 1000 shares. So the custodian bank can provide irrevocable payment commitment to the clearing corporation that in case the XYZ is the client that is not able to pay, then the custodian bank will be responsible to pay for the whole of the trade. Now, why the custodian bank is providing this irrevocable payment commitment? So that the client gets the shares without any problem, and the client has also provided some fees for the custodian bank to take this kind of risk. Custodian bank may issue irrevocable payment commitment on behalf of their clients in favor of the clearing corporation of a stock exchange, subject to meeting one of the following condition. One of the following conditions should be met. Bank has inalienable. Now this custodian bank, if it is providing the irrevocable payment commitment, it should have the complete right over the securities that will be received in settlement. And when the client finally pays, then only the custodian bank will release the shares in the name of the client. I hope this is clear that if the custodian bank is providing the irrevocable payment commitment, then the custodian bank should have the inalienable right, that means complete right on the securities, on the shares should be of the custodian bank, which will release the shares for the name of the client only when the client has paid completely. Or if this condition is not being met, if the client is not agreeing to this, that no, I cannot provide you the complete right over the securities that will be received in the settlement, then the second condition is that the client has to maintain the complete amount. So if 1 crore is the amount needed for the trade, the complete amount should be in the accounts of the client. So transaction must be fully pre-funded, clear funds are available in the customer's account. Okay, so this is the idea that the custodian bank can only issue the irrevocable payment commitment on behalf of their clients in favor of the clearing corporation of a stock exchange if the bank has the inalienable right, the complete right over the securities, or the transaction is fully pre-funded. That means the customer has the complete amount in its account. That is the idea. Now, a custodian bank can provide the irrevocable payment commitment that we have understood. Now, this irrevocable payment commitment is said to have the credit conversion factor of 100%. That because the irrevocable payment commitment, if it is of 1 crore, that means the custodian bank has taken this exposure of 1 crore. What if the client does not pay? What if the client does not pay? The custodian bank will have to pay this 1 crore rupees to get the shares, because the transaction cannot stop. In the stock exchange, if the transaction has been initiated, the clearing corporation has the responsibility to clear and settle the trade. So if the transaction has been initiated by the client and the custodian bank has provided the irrevocable payment commitment to the clearing corporation, then the trade has to be settled. Okay, so if the client is not providing the money, the custodian bank that has provided the irrevocable payment commitment has to provide the money. So basically, the irrevocable payment commitment has the credit conversion factor of 100%, because IPC represents, the irrevocable payment commitment represents a full unconditional financial guarantee, exposing the bank to the entire committed amount that has to be paid by the custodian bank if the client fails. Okay, now however, buffer capital is not required. If 1 crore is the irrevocable payment commitment, it is not required that 1 crore should be the buffer capital also. That means the provisions the extra provisions that the bank has to maintain is need not 1 crore, is need not be 1 crore, because you can understand that if the irrevocable payment commitment has been provided by the custodian bank and the client does not have the funds in its own account, that means the bank has, because one of the two conditions should be followed. If the client does not have the money in its account, that means the bank has, the custodian bank has the complete right, inalienable right over the security, over the shares. Okay, so shares must be worth something, like if 1 crore was paid to buy 1000 shares, even if the trade is settled tomorrow and by tomorrow the shares are worth less, maybe they are worth 90 lakhs now, still the custodian bank has the, or the shares are worth 80 lakhs now, still the custodian bank is able to get some value, right? So the buffer should be maintained only how much? So buffer capital is not required to be maintained on the full irrevocable payment commitment amount. Capital is required, or the buffer capital or the provisions have to be maintained only on the portion that is reckoned as capital market exposure. That means if the trade is initiated today and the settlement will happen tomorrow. So trade is initiated today and the shares were 1000 shares for 1 crore rupees was promised today. So by tomorrow the share value might decrease. So that is the capital market exposure, the price exposure, okay, or the volatility exposure. The maximum intraday risk, the maximum one-day risk, because the settlement will happen tomorrow. So by tomorrow the share price can change, but the maximum intraday risk to the custodian bank is considered at 30% of the settlement amount. So if the settlement amount is 1 crore, so 30%, that is 30 lakh, this is considered the capital market exposure, because it is considered that in one day 20% is the downward price movement that can happen maximum, and 10% is the extra margin that is kept for further downward movement. So 30% is the maximum capital market exposure. So against this 30 lakh the bank has to maintain the buffer, and against this 30 lakh, against this 30%, the risk weight, the capital that has to be maintained is 125%. So that means against the 30 lakhs, against this 30%, that is 30 lakhs, 125% of the capital the bank has to maintain with itself. That is the idea. So basically the idea is 1 crore rupees is the irrevocable payment commitment. This is a credit conversion factor of 100%. That means 1 crore rupees is completely the risk and the responsibility of the bank now. So it is the irrevocable payment commitment. But now this 1 crore rupees is not completely a risk for the bank, because the capital market exposure for the T+1 settlement cycle, the capital market exposure, the downward price movement can be considered at maximum 30%. Intraday, in one day 20% downward price movement can happen, and 10% is the extra margin. Okay, so 30%, this is the capital buffer that the bank has to maintain. So 30% is the capital market exposure. So against this, the capital buffer the bank has to maintain, and the capital buffer should be 125, should have the, like the capital market exposure should have the 125% of the risk weight. This is the idea. Okay, I hope this is clear, that the irrevocable payment commitment has been provided by the custodian bank, let's say worth 1 crore rupees. Now this is not completely the risk, so buffer do not have to be maintained against this whole value. Buffer has to be maintained against the capital market exposure, that is considered 30% for the T+1 settlement cycle. Okay, so 30% is the capital market exposure. Against this 30% of the value, 125% is the risk weight. So this much of the capital buffer has to be maintained. Okay, so for the 30 lakhs of the capital market exposure, 125% of the capital buffers have to be maintained. And let's say that the when the client initiated the trade, the client provided the margin of 10 lakh rupees. So that has to be deducted, because the client has already provided 10 lakh rupees. So against, so from the buffers, this 10 lakh rupees can be deducted. Okay, because this was already provided by the client as the security. So this is the idea. Remember that the risk weight is 125%, the capital market exposure. So the amount classified as capital market exposure, it attracts a risk weight of 125%, and capital shall be maintained on that risk weighted amount only. So capital has to be maintained, against the 125% of the 30%. That is the idea. Okay, so this is the idea. Now coming to the last part for this session, that is credit facilities to capital market intermediaries. Credit facility to the capital market intermediaries. See, in the capital market that is regulated by the SEBI, the capital market that is regulated by the SEBI, basically there are the market infrastructure institutions. Like there are stock exchanges, there are clearing corporation, there are depositories. Okay, so these are the market infrastructure institutions that help in the capital market performance and the functioning of the capital market. So stock exchanges, NSE, BSE, clearing corporation like the CCIL, depositories that keep your securities in the demat form like the NSDL, CDSL. Now, these market infrastructure institutions that are helping in the functioning of the capital market, they have their own intermediaries. In the stock exchange, you have brokers as the capital market intermediaries. Okay, brokers, they connect the investors to the stock exchanges. Clearing corporations, they have the capital market intermediary, that is clearing members. They help in the clearing and settlement of the trade for the investors through the clearing corporation. Depositories, they have the intermediaries, that is the depository participants that help in the maintenance of the securities in the demat form. So these are the capital market intermediaries, brokers, clearing members and such. It has been said that the credit facilities can be extended only through the capital market intermediaries that are registered and regulated by the financial sector regulator, that is SEBI in our country, and are in compliance. So the loans, the credit facilities, the loans or the guarantees can be provided by the bank to the capital market intermediary, to the broker, to the clearing member, only to such capital market intermediaries that are registered and regulated by the financial sector regulator, and they are in compliance with the prudential norms prescribed by such regulator. So they are also following the norms, regulations of the regulator. Okay, a bank can provide need-based credit facilities to the capital market intermediaries. So basically loans can be provided to the capital market intermediaries to fund their day-to-day operations, so that the functioning of the capital market can happen smoothly and the functioning in the stock exchanges, in the clearing corporations can happen smoothly. So for the day-to-day operations, the capital market intermediaries can take the loan from the bank. In general, all the credit facilities that is provided to the capital market intermediaries, they shall be provided on a fully secured basis. That means 100% of collateral has to be taken. So if the loan is given for 10 lakh rupees, the 10 lakh worth of collateral has to be taken from the intermediary. Okay, so if the broker is taking 10 lakh rupees of the loan from the bank, the broker has to provide the securities that are worth 10 lakh rupees. The broker has to provide the collateral worth 10 lakh rupees to the bank. Okay, remember that a bank shall apply minimum haircut of 40% for equity shares. That means the shares, let's say they have the value of 1 crore. Only 60% of their market value. They have the market value of 1 crore. Only 60% of the market value can be considered collateral. This is the basic idea. So minimum haircut, that means minimum deduction. In the share value, minimum deduction should be taken at 40%. So a bank, if it is taking the shares as collateral, if the bank is taking the shares as collateral, the bank has to only consider 60% of the value of the shares. So if the loan is provided by the bank to the broker, the loan is worth 10 lakh rupees. So the broker will have to provide the shares as collateral worth how much? 14 lakh. So that 40%, or sorry, 40 lakh or 50 lakh. And such. So that 40% can be the haircut and 60% of the value will be considered. Okay, 20 lakh, let's say. So 60% of the value will be considered. That means the collateral value then will be 12 lakh or something. Okay, so this is the basic idea. So if the loan that is provided by the broker, if the loan is provided by the bank to the broker and the loan is worth 10 lakh rupees, so the broker has to provide the share as the collateral. If the bank is providing the shares, if the broker is providing the shares as the collateral value should be higher because there is a minimum haircut of 40% that is taken. So this is the idea. If the loan is provided the bank to the broker and the broker is taking the loan worth 10 lakh rupees, the broker is providing the collateral as shares. So the shares should be worth 20 lakh rupees or such, 18 lakh or 20 lakh rupees. So that because only 60% of the share value is considered. Only 60% of the current market value of share is considered. 40% is the haircut. Okay. Now coming to the next one. So here I hope this is clear that if the bank is providing the credit facility to the capital market intermediary, a collateral has to be taken, that is 100% of the value of the loan. Now, a bank may also issue guarantees. A bank can also issue the guarantees on behalf of the brokers or professional clearing members and in favor of the exchanges or clearing houses as applicable. So basically, let's take an example that if a broker needs 10 lakh rupees margin requirement, or broker needs 10 lakh rupees as the security deposit, that has to be given to the exchange, to the stock exchange. Okay, so if a broker needs 10 lakh rupees for the security deposit or for the margin requirement, that has to be given to the clearing corporation or to the exchange. Bank issues. Now broker, rather than giving this amount, the broker is taking the guarantee from the bank. Now the bank issues guarantee of 10 lakh rupees in favor of the clearing corporation. Broker must provide. So this is the idea, that broker, rather than paying the margin requirement or the security deposit of 10 lakh rupees, rather than blocking the funds, the broker can take the bank guarantee from the bank worth this 10 lakh rupees, and this guarantee can be provided to the clearing corporation or to the exchange. Okay, so here the broker is not blocking its funds, the broker is just taking the bank guarantee by providing some collateral. The broker is taking the bank guarantee. Okay, so this is the idea. Such bank guarantee shall be secured by a minimum collateral of 50%. So if the bank guarantee is 10 lakh rupees, minimum collateral that has to be provided by the broker is 50%, that is 5 lakh rupees. Okay, out of which 25% shall be in cash. 25% shall be in cash. So broker had to give the margin requirement to the clearing corporation. The broker had to give the margin requirement to the clearing corporation worth 10 lakh rupees. So rather than blocking its 10 lakh rupees, the broker can provide the bank guarantee to the clearing corporation, and the bank guarantee has to be secured by a collateral of 50%. Okay, so this bank guarantee, 50% of the collateral value should be there. So that means the collateral, 5 lakh rupees worth of collateral, has to be provided by the broker, and out of this 25%, that means 2.5 lakhs should be in cash. So rather than blocking its 10 lakh rupees, it is only blocking its 2.5 lakh, and it is giving the rest of the 2.5 lakh in shares or in some other valuation. Okay, so that is the idea. So such bank guarantees can be taken by the broker or the clearing member, and this bank guarantee shall be secured by a minimum collateral of 50%, out of which 25% shall be in cash. A bank may extend guarantees. Now this is the trade that is the broker is doing on behalf of the client, or the clearing member is doing on behalf of its client. But let's say the broker, they are doing the proprietary trading. That means they are trading on their own account. The broker is trading for its own purpose. Okay, so bank may extend guarantees. Bank can extend the guarantees. The bank guarantee can be provided to the broker even for its own trade that it is doing, but this kind of guarantee should be 100% secured. This kind of guarantee, this kind of bank guarantee that the broker is taking for itself, for its own trade, it should be secured 100%. This bank guarantee should be secured 100%. 50% can be in the form of eligible securities. 50% of collateral can be in the form of eligible securities, and the other 50%, or the government securities particularly, and the other 50% in the form of cash. This is the idea. Okay, so here I hope this is clear that if the bank is providing loans to the broker or the clearing member and such, in this case 100% of collateral has to be taken from the broker and the clearing member. Okay, for the loan 100% of collateral has to be taken, and the shares, if the shares are provided as collateral, so share have a 40% of haircut. That means only 60% of the share value can be considered for the collateral. Now if the banks are providing guarantee to the broker or the clearing member, this guarantee, if it is provided for the trade of the client through the broker, this bank guarantee is provided to the broker for the trade that is happening in the client's account, or the trade that is happening for the client. So in this kind of guarantee, in this kind of bank guarantee, the collateral has to be provided by the broker, that is 50% of the bank guarantee value, and this collateral 25% can be in the form of government securities and such. 25% of the collateral should be in the form of cash. While if the bank guarantee is taken for the broker for its own trade, here client is not involved, broker is taking the bank guarantee for its own trade to provide this bank guarantee to the clearing corporation. In this case, the collateral has to be provided by the broker, that is 100% of collateral against the bank guarantee, and 50% can be in the form of government securities, 50% of the collateral can be in the form of government securities and such, and 50% has to be in cash. Okay, so that is the idea. Minimum 50% shall be in cash for the bank guarantee for the proprietary trading. Any confusion, anyone? So this is it. The directions were long, but I hope you were able to get the basic idea. And this is the important idea that you needed to have for the credit facilities amendment directions for the commercial banks, for the small finance banks. Okay. Now this is the first question. I hope you will be easily able to answer this question. Do try to answer this question. And which of the following can be accepted as eligible securities by banks for granting loans against securities as per RBI guidelines? So you have to tell that what are the eligible securities. Next is, banks may fix their own prudential limits in terms of their approved policy for loans to individuals against collateral for government securities, listed debt securities and such. The amount of loan that can be granted to individuals against other eligible securities shall be capped at what? So banks can decide their own prudential limits for certain securities, but for other securities, what is the cap that has been decided by the Reserve Bank of India? So these are the two questions. I hope you will be able to answer this question. And this is it. Thank you everyone. Thank you for joining the session. If there is any confusion, you can write down in the comment section below. So thank you everyone. Thank you for joining.